Welcome to the Explainer. If you're a CMA student gearing up for your exams, you are literally in the perfect place. Today, we're going to demystify two absolutely critical, deeply intertwined topics: audit risk and internal controls. Now, I know these concepts can sometimes feel like this giant maze of technical jargon, but my goal today is to break them down into clear, structured, and totally memorable pieces. By the end of this explainer, you're going to have a rock-solid framework for understanding exactly how risks are assessed and how organizations build their internal defenses. So, let's get right into it. Here's our quick roadmap for today. We're breaking this down into 5 parts. 1. Risk versus uncertainty. 2. The anatomy of audit risk. 3. Checking out real-world risk with JMART. 4. Controls, checks, and audits. And finally, 5. Auditor roles and risk. Keep this mental outline handy. It's really going to help you categorize the info for your exams.
All right, Section 1, Risk versus Uncertainty.
You know, in our day-to-day lives, we tend to use the words risk and uncertainty interchangeably. But in a business and auditing context, they are fundamentally different beasts. Risk refers to a situation where the potential outcomes are known, they can actually be measured and quantified through theoretical models, and crucially, risk can be minimized or controlled by taking precautions. Uncertainty, on the other hand, is the complete absence of certainty. The outcomes are totally unknown, unmeasurable, and completely beyond the control of the enterprise. For your exams, just remember this. As auditors and management accountants, we manage risk, specifically because it can be quantified and mitigated.
Moving on to Section 2, the anatomy of audit risk.
Let's lock down the core definition here. Audit risk is the risk that an auditor gives an inappropriate opinion when the financial statements are materially misstated. To really see this, let's use an exact example from your syllabus. Imagine a company, A Limited, spends 50 lakh rupees to repair a machine. Now, this repair boosts the machine's capacity by 30%, which means it absolutely should be capitalized. But, oops, the accountant mistakenly debits the repairs and maintenance account instead, treating the whole thing as a revenue expenditure. If the auditor overlooks this massive error and issues a clean, happy report, their opinion is inappropriate. That failure? That is audit risk in action. Now, here is a pro tip. It's just as crucial to understand what audit risk is not, because exam questions absolutely love to trick you with this. Audit risk does not include the scenario where an auditor says the statements are misstated when actually they aren't. It also entirely excludes the personal business risks of the auditor, so things like losing money due to litigation or getting negative publicity from taking on a controversial client. Not audit risk. Audit risk is strictly technical and relates directly to the audit of the client's financial statements.
Okay, so to understand how audit risk actually happens, we need to look at the risk of material misstatement. This risk can exist at the overall financial statement level, affecting everything, or down at the assertion level. At the assertion level, it breaks into 2 components, and the first one is inherent risk. This is the natural susceptibility of an account balance to be materially misstated, assuming 0 internal controls exist. Think of it as the raw, baseline risk of the business. The source material points out that inherent risk spikes for complex or unique transactions. For example, if a company suffers fire damage or acquires another business, those are non-occurring, highly complex events. The auditor runs a massive inherent risk of focusing too much or way too little on those unique situations.
The second component of risk at the assertion level is control risk. This is the risk that a material misstatement just won't be prevented or detected and corrected in time by the entity's internal control system. Now, obviously, a sound internal control system significantly reduces this risk, but because every system has inherent limitations, it can never eliminate it entirely. For instance, if an organization's controls are kind of sloppy, bank reconciliations might just sit there unprepared for a whole month, or maybe they're done but not appropriately reviewed. That failure in the system itself, that is control risk. And that brings us to the final piece of the puzzle, detection risk. Unlike the other two, this rests entirely on the auditor's shoulders. It's the possibility that the audit procedures the auditor chooses to apply will simply fail to detect a misstatement that's sitting right there. Why does this happen? Well, auditors don't check 100% of every single transaction. If an auditor applies a testing method that, say, only checks the mathematical accuracy of a sales invoice, rather than verifying if the actual sale even occurred, they've created a blind spot. That's a classic example of detection risk. So how does this all tie together? Well, it brilliantly forms a mathematical equation, and I really want you to burn this into your memory. First, the risk of material misstatement prior to the audit is inherent risk multiplied by control risk. Therefore, total audit risk equals inherent risk times control risk times detection risk.
I times C times D. If management's inherent and control risks are sky high, the auditor has to perform much more rigorous procedures to drive their own detection risk down. That's the only way to keep the total audit risk at an acceptably low level.
Let's take all this theory into the real world. Section 3, Real World Risk with J-Mart. Imagine J-Mart Ltd. They are a massive multi-brand retailer operating in tons of locations nationwide, selling thousands of categories of products. To manage all this chaos, every product has a price tag with a barcode, plus a security tag that only gets removed at billing. On top of that, the auditor physically verifies inventory records on a fortnightly basis. On the surface, this setup looks incredibly secure, right? But how does our risk equation actually play out in this environment?
Let's walk through it logically. Step 1, inherent risk. In the retail game, inventory is naturally highly susceptible to theft. It's entirely possible that employees might misappropriate inventory by manipulating the records. That's the baseline risk. Step 2, control risk. Sure, J-Mart has barcodes, security tags, and fortnightly checks. The controls look pretty solid. However, if employees at multiple layers decide to collude together, they can bypass those controls completely. The risk of that collusion happening is your control risk. Finally, step 3, detection risk. The auditor evaluates all these controls and decides on a certain level of test checking. But because they're only test checking and not counting every single item in the store every single day, there is always a possibility that material misstatements will slip through undetected. That is the constant, looming presence of detection risk.
Next up, Section 4, Controls, Checks, and Audits. So, with all these risks identified, organizations need defense mechanisms. That's where internal controls come in. Internal controls are incredibly broad. They are the overarching, systematic, and procedural steps adopted by an organization to mitigate risks. We're talking about everything from financial accounting and reporting all the way to operational processing and legal compliance. They are, at their core, risk mitigation steps taken to strengthen the organization's systems, prevent errors, and sniff out fraud. Now, right underneath that massive umbrella of internal control, we have a very specific mechanism called an internal check. The Institute of Chartered Accountants of England and Wales defines this beautifully. An internal check is a system of allocating duties among staff in such a way that the work of one person is independently and automatically checked by the next person, just as part of the normal routine. The goal here is simple but super powerful. You want to prevent or very quickly detect errors and frauds by making absolutely sure that no single employee has exclusive control over any transaction from start to finish. For the exams, you absolutely must be able to distinguish between internal control, internal check, and internal audit. So let's meticulously break them down. First, the mode of checking. Internal check happens simultaneously, right, as part of routine transactions. Internal control is the broader, systemic setup where one person's work is checked by another. Internal audit, however, checks each component of work after it's completely done. Next, the objective. Internal check aims to prevent anyone from having exclusive control over a transaction. Internal control aims to ensure everyone is sticking to policies and that assets are safe. Internal audit's job is to evaluate that control system itself and detect frauds. And lastly, point of time. Internal check is continuous, happening during the transaction. Internal audit is basically a postmortem. It happens after the fact. Let's bring it all home with Section 5, Auditor Roles and Risk. A big takeaway here is understanding the scope of different types of auditors. A statutory auditor, so your external, independent auditor, is primarily zeroed in on financial and accounting controls. Their ultimate job is just to express an opinion on whether the financial statements give a true and fair view. But an internal auditor's scope, it's actually way wider. When performing an operational audit, the internal auditor reviews all controls. This includes operational controls like quality standards, budgetary controls, and policy appraisals. They're literally checking the pulse and health of the entire organization's processes, not just the final financial output. And regardless of whether they are an internal or statutory auditor, Standard SA 200 makes one critical clarification. An auditor never, ever gives an absolute guarantee that statements are free from misstatement. Instead, they provide what's called reasonable assurance. Reasonable assurance is achieved when the auditor has gathered sufficient and appropriate audit evidence to drag that total audit risk we talked about earlier down to an acceptably low level. Sufficiency refers to the quantity of the evidence, and appropriateness refers to the quality. Which brings us to a final, slightly provocative thought. We know that inherent and control risks belong to the entity. We know that detection risk belongs to the auditor, And we also know that because we literally can't test everything, detection risk can never be fully reduced to zero. So as future management accountants and auditors, how are you going to design your future audit procedures? How will you use your deep understanding of the business environment and internal checks to uncover those invisible errors? It's a massive responsibility, for sure, but mastering these core concepts today is your very first step.
This session is designed specifically to get you ready for your CMA exam. If you've been following along, you know that understanding risk isn't just about memorizing textbook definitions, it's about seeing how all the pieces actually fit together in the real world. Okay, let's dive right in. So here's the game plan for today. First, we'll look at the audit risk equation. Then we'll do a deep dive into detection risk, walk through a solved case study featuring a company called JMart, and finally, wrap things up with SA 315 risk assessment.
All right, part 1, the audit risk equation. Before we even look at the math, I want you to think about this. What actually causes an inappropriate audit opinion? Think back to our previous session. The ultimate nightmare for an auditor is giving a clean bill of health to a company when the financial statements are actually materially misstated. It's basically a disaster, and the equation we're about to look at mathematically explains exactly how that happens.
So, at the highest level, audit risk is a combination of two massive forces. On one side, you've got the risk of material misstatement, or RMM. That's simply the risk that the financials are already messed up before the auditor even walks through the door. On the flip side, you have detection risk, which is the risk that the auditor's very own procedures completely fail to catch those mess-ups.
Let's zoom in on that first half for a second. The risk of material misstatement actually splits into two subcomponents, inherent risk and control risk. Inherent risk is just the raw susceptibility of an assertion to be misstated. Control risk is the risk that the company's internal controls fail to prevent or detect that misstatement. Now remember, both of these are the client's risks. They exist entirely independently of the audit.
Putting all those pieces together gives us the ultimate formula you absolutely have to know for the exam. Audit risk equals inherent risk times control risk times detection risk. Moving right along to part 2, a deep dive into detection risk. Straight from your syllabus, detection risk is the possibility that the audit procedures applied by the auditor to reduce audit risk to an acceptably low level simply will not be able to detect a misstatement which could be material. Remember how we just said inherent and control risks belong to the client? Well, detection risk is all on us. It rests squarely on the auditor's shoulders. To put that into perspective, let's look at a classic example. Say an auditor applies a testing method that strictly checks the mathematical accuracy of a sales invoice. The math checks out. Great. But what if they completely failed to check the actual occurrence of that sale? Did the transaction even happen? Because they applied the wrong testing method for what they needed to prove, they just ran headfirst into a detection risk. All right, let's see how this actually plays out. Part 3, our solved case study on JMart.
Here are the facts of the case. JMart Ltd. is a multi-brand retailer operating in multiple locations across the nation. They sell thousands of categories, from food to consumer durables. Now picture the store environment. Every single product item has a price tag with a barcode. Plus, there's an additional security tag that only gets removed after the billing is done. Oh, and inventory records are physically verified on a fortnightly basis by the auditor. Sounds pretty airtight, right?
So, here's your direct exam question. Identify the risk associated with the audit of inventory in JMart. I want you to apply that audit risk framework we just built. Think about the equation. How do inherent, control, and detection risks apply to this specific scenario? Let's break down the solution. Starting with inherent risk. The reality is it is entirely possible that employees might have misappropriated the inventory by manipulating the inventory records. So those inventory records might simply not be accurate. That fundamental threat leads directly to a risk of material misstatement. Now, what about control risk? Look, on paper, having barcodes, security codes removed to billing, and fortnightly physical verifications appears to be quite satisfying. But here's the catch: collusion. Collusion among employees at multiple layers can evade those implemented controls at any time. Because of that human element, an element of control risk is absolutely present. And finally, detection risk. We expect the auditor to apply appropriate procedures to judge the efficiency of the control system before deciding on the extent of their testing. But because they are adopting test checking, meaning they aren't verifying 100% of the items, there is still a possibility that material misstatements go undetected. Therefore, an element of detection risk also exists. Let's move into our final section, SA 315 and risk assessment. Now, as per SA 315, you have to perform risk assessment procedures to provide a basis for the identification and assessment of risks at the financial statement and assertion levels, but watch out for this trap on the exam. These procedures provide a basis for identification, but they do not provide sufficient appropriate audit evidence on their own to base your audit opinion on. They are just the foundation. So, what actually are these foundation-building procedures? SA 315 breaks them down into three main buckets. Number 1, inquiries of management and of others within the entity. Number 2, analytical procedures. And number 3, observation and inspection. Let's look at how each of these works. Let's look at inquiries first. Obviously, you talk to management, but getting different perspectives is key. If you direct inquiries to those charged with governance, they can help you understand the whole environment in which the financial statements are prepared. If you ask the employees actually processing complex or unusual transactions, you can evaluate if the accounting policies being applied are appropriate. And if you chat with marketing or sales personnel, they can give you the scoop on changes in sales trends, strategies, or even new customer contracts.
Next up, we have analytical procedures. Honestly, these are great for spotting things you might have totally missed otherwise. You're basically looking for unusual transactions, amounts, ratios, or trends that indicate matters with major audit implications. It's all about finding those red flags hiding in the numbers.
And the final piece is observation and inspection. This is where you actually gather physical evidence. You're inspecting the entity's operations, digging through documents, records, and internal control manuals. You are reading management or board reports, and you're physically observing the premises and plant facilities to see things with your own eyes. Well, we've covered a ton of ground today, from the audit risk equation all the way to SA 315 procedures. So I want to leave you with a quick thought experiment for your exam prep. Let's say you're doing your observation and you detect a massive control risk. The internal controls are basically non-existent. Based on the formula we learned, how will you, as the auditor, need to adjust your detection risk to save the audit and keep the overall risk acceptably low? Think about how those variables interact. Today, we're opening up the Auditor's Toolkit to see exactly how we gather clues to assess the risk of material misstatements. We're going to treat the auditor like an investigator today because, well, assessing risk is all about gathering the right evidence from the exact right places before you even begin the heavy lifting of the audit itself. Think of this as your syllabus for today's session. We'll be looking at three main sources we use to build our investigative case: prior periods, team discussions, and the entity and its controls. All right, let's jump right into our first major source of clues: information obtained in prior periods. When an auditor has history with a client, we don't just start from scratch. Our previous experience and past procedures act like a really detailed case history. This reveals crucial insights like past misstatements, but it goes deeper than just finding old errors. We want to know, did the client actually correct those past misstatements on a timely basis? Plus, looking at prior periods helps us spot any significant changes to the entity or its operations that could completely alter the risk landscape. So why does this matter? Well, this historical data is incredibly valuable. It assists the auditor in gaining a sufficient understanding of the entity to identify and assess present-day risks of material misstatement. By knowing exactly where the weak spots were last year, you basically know exactly where to shine your flashlight this year.
Moving right along to source number 2, team discussions.
Now, auditing is definitely not a solo sport. It's a highly collaborative investigation. For your exam prep, you've really got to ask yourself, why is simply talking with your team considered a critical step in assessing susceptibility to material misstatement? It sounds basic, sure, but there are very specific reasons for it.
A formal team discussion provides the perfect opportunity for experienced members to share their deep insights based on their knowledge of the entity. It allows the team to exchange critical information about business risks, and for team members handling specific areas, it really helps them understand the potential for misstatement in their assigned tasks. Most importantly, though, it gives us a basis to communicate and share new information obtained throughout the audit that might affect our risk assessment down the line.
Okay, let's hit our third source: the entity, its environment, and internal controls. You simply cannot audit numbers in a vacuum, right? You have to understand the real-world machine that generated those numbers. External and internal factors have a massive bearing on risk. For example, long-term contracts immediately give rise to specific risks because they involve significant estimates of revenues and expenses. If you're in a regulated industry, things like taxation, government policies, and the regulatory framework can be huge potential sources of risk. Even just having a complex entity structure with intricate ownership and stakeholder relations can directly give rise to audit risk. And right inside that environment, we have to thoroughly evaluate internal control. Understanding a company's internal control directly assists us in identifying the exact types of potential misstatements that could occur and the factors affecting those risks. Ultimately, you use this understanding to design the nature, timing, and extent of your further audit procedures.
But here is a massive caveat and an absolutely crucial point for your exam. Internal control, no matter how amazingly effective it might seem, can provide an entity with only reasonable assurance about achieving its financial reporting objectives. Why? Because the likelihood of achievement is always affected by inherent limitations of internal control. Perfection is literally impossible here.
Because of those inherent limitations, getting an understanding of the entity and its internal control isn't just a one-and-done checklist you fill out on day one. It's actually a continuous, dynamic process of gathering, updating, and analyzing information throughout the entire audit. This understanding establishes a frame of reference so the auditor can plan the audit and exercise professional judgment from start to finish.
Which brings us to a major plot twist: expectation versus reality.
This is a highly testable pivot point in our investigation. You've done the planning, you've assessed the risk, but the real world has other ideas. During the audit, information might pop up that differs significantly from your original assessment. For instance, your initial assessment might be based on an expectation that certain internal controls are operating effectively. But in reality, when you actually test those controls, you might obtain audit evidence showing they completely failed at relevant times.
Or, let's say your risk assessment predicts a super low frequency of errors. However, when you perform your substantive procedures, boom, you detect misstatements in amounts or frequencies that are way greater than what is consistent with your initial risk assessments. The reality is heavily clashing with your expectations.
When you hit this kind of roadblock, you can't just stubbornly stick to the original plan. In circumstances like this, your original risk assessment may no longer appropriately reflect the true circumstances of the entity. And if the risk assessment is off, it means your further planned audit procedures may not be effective in detecting material misstatements anymore.
You have to pivot.
So as future CMAs heading into the field, I want to leave you with this final thought. If the financial clues are constantly evolving, and if your initial risk assessment is merely a starting point that has to dynamically change, how will you ensure your audit plan stays sharp enough to uncover the truth? Audit risk isn't static. It's a living, breathing puzzle.
We're diving right back into the fascinating, high-stakes world of auditing. Think about it for a second. When an auditor walks into a massive corporation, how do they actually figure out if a pristine-looking financial statement is secretly hiding a massive material error? It's not guesswork, right? And it's definitely not magic. It all comes down to a highly methodical process of identifying and measuring the risk of things going wrong.
So here's our roadmap for today. We're going to cover 1. What is audit risk? 2. Types of audit risk. 3. Assessing audit risk. 4. Analytical procedures. And finally, 5. Observation and inspection. Let's get right into it.
Section 1, what exactly is audit risk?
Now, look at the specific wording here on the slide. Audit risk is the risk that an auditor gives an inappropriate opinion when the financial statements are materially misstated. Simply put, it's the danger of you, the professional, completely missing a massive error and mistakenly giving the company a clean bill of health. Say a company misclassifies a major capital expenditure, like a massive machinery upgrade, as just a basic revenue expense for repairs in the statement of profit and loss. If you overlook that and don't report the error, you've just given an inappropriate opinion. That right there is audit risk in action. And just a quick note for the exam, this does not include the auditor's business risks, like getting sued or bad PR. It is strictly technical.
Moving on to Section 2, types of audit risk.
So overall audit risk is actually a combination of two main branches. On one side, we've got the risk of material misstatement. This is the risk that the financial statements are already materially misstated before the audit exercise even begins. It's the risk sitting there before you even step foot in the office. On the flip side, we have detection risk. This is the risk that your own procedures fail to catch those misstatements. Let's break these down a bit more.
The risk of material misstatement is split into two subcomponents, and first up is inherent risk. I love this one because it really captures the natural dangers in business. Inherent risk is the susceptibility of an assertion to a material misstatement before you even consider any internal controls. Some things are just naturally riskier, right? For instance, complex, non-recurring transactions, like dealing with sudden fire damage or acquiring a whole other company, they inherently carry way more danger.
The auditor runs a much higher risk of focusing too much or too little on these unique events, simply because they aren't your standard everyday transactions.
The second subcomponent of the risk of material misstatement is control risk. If inherent risk is the natural danger, control risk represents a failure in the company's own internal safety nets. It's the risk that a material error could occur and the entity's internal control system totally fails to prevent it or fails to detect and correct it in a timely manner. Put these two together, inherent risk and control risk, and you get your overall risk of material misstatement. And remember, these belong entirely to the entity.
Okay, so how do you, the auditor, respond? That brings us to detection risk. This is the risk that the audit procedures you apply fail to reduce the audit risk to an acceptably low level. This one is entirely on you. Imagine you apply a testing method that only checks the mathematical accuracy of an invoice, but you don't check if that particular sale actually happened. You're walking straight into a detection risk. You might verify the math perfectly, but completely miss that the entire transaction was fake. To keep overall audit risk low, you have to constantly adjust your procedures to keep detection risk acceptably low based on your assessment of the inherent and control risks. Which brings us to Section 3, Assessing Audit Risk. Under Standard on Auditing, or SA 315, you are required to perform specific risk assessment procedures. Step 1, you have to obtain a deep understanding of the entity and its environment. Step 2, understand their internal controls. And Step 3, based on all that, you identify and assess the risks of material misstatement at both the overall financial statement level and zooming way in, down at the specific assertion level. Now keep in mind, these risk assessment procedures alone don't give you sufficient evidence to base an audit opinion on, but they are the absolute foundation. They provide the basis for designing all further audit responses. All right, Section 4, Analytical Procedures. According to SA 520, an analytical procedure is the evaluation of financial information through the analysis of plausible relationships. Basically, you're looking at the data and asking, wait, does this actually make logical sense? It encompasses investigating any identified fluctuations or relationships that are totally inconsistent with other relevant information or that differ from expected values by a significant amount. Let's de-jargon this a bit with a really great example from our source text. Analytical procedures don't just look at the money. They compare financial data against non-financial data. Imagine comparing sales revenue, which is your financial data, directly to the square footage of the selling space, or the volume of goods sold, which is your non-financial data. If a store has a tiny square footage but is reporting astronomically high sales figures compared to industry averages, boom, that is an unexpected relationship. It tells you that something might be seriously off and you need to investigate further. When you perform these as risk assessment procedures, these analytical tools are incredibly powerful. They help identify aspects of the business you might have been totally unaware of. They shine a massive spotlight on unusual transactions, events, amounts, ratios, or trends that have direct audit implications. And most importantly, when you spot those unexpected relationships, they assist you in pinpointing risks of material misstatement, especially those sneaky risks of material misstatement due to intentional fraud. But, and this is a crucial caveat here for your exam prep, you need to remember this. When your analytical procedures use data that's aggregated at a really high level, the results only give you a broad initial indication about whether a material misstatement may exist. It is a starting point. A red flag to guide your focus, sure, but it is not absolute proof on its own. You absolutely cannot base your final audit opinion just on a high-level trend analysis. You've got to dig deeper. And that brings us to Section 5, Observation and Inspection. Observation and inspection really support the inquiries you make to management and others, and they provide critical information about the entity and its environment. Our text details 4 specific areas where this is applied. First up, observing the entity's actual operations. Second, inspecting documents like business plans and strategies, records, and internal control manuals. Third, inspecting reports prepared by management. Think quarterly management reports and interim financial statements, and those charged with governance, like the minutes of board of directors meetings. And finally, inspecting the entity's premises and plant facilities. I mean, you can't just take management's word that a shiny new factory was built. You have to physically go look at it. We have covered a ton of ground today, from the fundamental definition of audit risk all the way down to the physical inspection of plant facilities. But as we wrap up, I want to leave you with a thought-provoking question to ponder as you continue studying. If procedures like high-level analytics only ever provide a broad initial indication, just how far must you go and how deep must you dig to practically guarantee a clean report? Well, the truth is that risk assessment is merely the beginning of the journey. An auditor must constantly maintain that professional skepticism, continually refine their procedures, and literally always follow the evidence. Keep that exact mindset as you tackle your CMA prep. Thanks for joining this explainer and happy studying.